Hello and welcome. This is Sam DeNorma with Brighton Securities, and today I want to talk about what happened over the weekend with Silicon Valley Bank. Friday, March 10th, the news broke that the FDIC had to step in and take over for Silicon Valley Bank, and then we were pretty much bombarded nonstop with news over the weekend, leading into today, Monday, March 13th. So this can be very complicated. Banking and finance, they obviously have a lot of regulations and there's a lot of jargon. So, what I really wanted to do today is just sort of break this down into a plain English explanation. We will try to simplify this as much as possible. We may gloss over a few details, but really the objective here is I don't want to get into the weeds. I just want to get this across in a way that I feel everybody could understand. So, the first thing that we need to talk about is Silicon Valley's customer base, right? So, this isn't your regular retail bank that just serves Mr. and Mrs. Rochester with their checking accounts and savings accounts, mortgages, and car loans. Silicon primarily serviced small tech companies, startups, and venture backed companies. So basically, what happened here is you have a bank whose customers are what you might just qualify as a big pool of high risk companies, right? They're startups. They're burning cash. They're not really earning a profit yet in most cases. And so what happened was over the past year, we've seen the cost of lending double. The cost of borrowing has doubled. And the venture capital sort of pipeline of cheap money also dried up a bit. So a lot of these companies have been having to dig in more and more into their cash reserves sitting in their bank accounts with banks like Silicon Valley Bank. So what Silicon did with the huge amount of capital that they had on hand from all of their banking customers is they found that they weren't really able to find good lending opportunities with that money. Okay. And so, being a bank and being that their objective is to make a profit, they invested that money. And so, primarily, they're buying extremely safe investments, things like treasuries. Okay. So, that's fine normally, except a few things happened. First, we saw interest rates go up significantly over the past year. What that means is that any bonds that you currently own, they decrease in value. Okay. So now the bank has a bunch of bonds on its balance sheet that are worth less than they paid for them. Okay. And normally this wouldn't be a problem because you would just simply hold the bonds to maturity. You're not really concerned with credit quality because these are US treasuries. But what happened was, and this is where the bank is sort of culpable, and they risk management had a massive failure here because they did something that we call mismatching duration. So they weren't happy back in 2020 and 2021 earning less than 1% or whatever they might have been getting on short-term bonds. And so they decided to put the bulk of their assets into longer term bonds. So, for instance, let's just say, to keep it simple, they put everything in 10-year treasuries. Okay, so again, these are high quality bonds, and as long as they could hold them to maturity, this wouldn't be a problem. However, what happened was, we mentioned that these startups are burning through their cash reserves sitting in the bank accounts. And all of a sudden, the bank found itself in a position where they didn't have enough cash on hand to meet the capital requirements where, you have to have, at any given time, you have to have a certain amount of cash on hand to meet customer withdrawal requests. And so all of a sudden, Silicon Valley Bank found themselves in a position where they were going to finally have to realize some losses and sell some of these long-term bonds to raise cash. And this is where everything sort of went wrong. It's a little bit unclear just how this happened, but my understanding is basically the community got wind when Silicon Valley started liquidating bonds that there might be a problem. And all of a sudden, it's as if somebody yelled fire in a crowded theater and everybody went rushing for the exits at the same time. We call this a bank run. And this is such a tight-knit community. But they were basically all talking to one another, and they were all saying, hey, you better hurry up and get your funds out of the bank before it goes belly up. And really, it became a self-fulfilling prophecy, and the FDIC had to step in and backstop everything here. So that's kind of what happened in a nutshell. And so, but what does this mean for the customers? What does this mean for the people who bank with them? Well, this is a little bit of a unique situation. Like I mentioned, Silicon Valley Bank isn't your regular retail bank, okay? The vast majority of deposits were well above the FDIC insurance limits of $250,000. So now we've got a bigger problem. What's going to happen with all of these customer funds above $250,000? Thankfully, it looks like the bank's assets covered the vast majority of deposits, even above and beyond the FDIC limits. I've heard anywhere between 80 to 95%. Even with all of the bond values down, they still had the assets there to cover the vast majority of customer deposits. So it's not a problem of the money not being there. It's a liquidity problem. They just didn't have quick access to it. And that's where we ran into a problem when everybody decided to pull their money at the same time. Thankfully, on Monday morning, we got news that the government basically said, we're going to step up to the pump here, and we will back 100% of customer deposits, regardless of FDIC limits. Really, I think that was the best move. They showed that they were willing to backstop all of the deposits to kind of stem any kind of concerns about contagion risk into other banks. Things start to get complicated here. They're setting up lending facilities. There's lots of acronyms that we don't really need to get into. But really what it comes down to is because we have quality assets backing the deposits, the government was willing to step in and say, look, it doesn't matter what the bonds are trading at right now. We will fully back all of the customer deposits. We'll get things moving as quickly as possible so that you don't have to worry about missing payroll or being more than just a couple days late with payroll. And hopefully we don't throw all of these tech companies into a liquidity crisis themselves. So it looks like we have a very good chance here that the government stepped in very quickly and authoritatively, and that things are going to hopefully settle down throughout the week. On the other hand, we have to be careful because we all know that while a single person can be very intelligent, groups of people can often be extremely irrational, right? Goes back to this idea of screaming fire in a crowded theater. So really what we want to hope to see is that volatility settles down rather than sort of cascading. And I think the government is doing everything that it can to ensure that happens. We'll just have to keep an eye out and see what happens going forward here. But right now, I think what we want to do is just let cooler heads prevail and just kind of take a look at things over the next few days and see what happens. So thanks for taking the time to watch the video. I hope you enjoy receiving, video content rather than a traditional typed out newsletter. I think this is a much more engaging way to discuss what's going on out in the markets. So if you found value in this video, I hope that you will like, subscribe, and share with your friends, family, and colleagues, and hope to see you back for the next video. Thanks so much.